In this video, I'm going to talk about owner's equity, what it is, and how it might be presented in your business. And I'm also going to briefly talk about some different transactions that might affect your owner's equity account. First of all, owner's equity is simply a representation of the owner's investment in the business. It's shown on the balance sheet, and the balance sheet is basically set up in an equation format. Your total assets, which are the resources and things you own in your business, are going to equal the debt of the business or liabilities plus equity. If you were to single out owner's equity in the equation, you would subtract liabilities from both sides, and it would change your equation to be assets minus liabilities equals owner's equity. If you were to liquidate your business, you would have resources or assets that you would sell, minus any debt you would pay, and whatever's left over would be the equity. Now, it wouldn't exactly happen like that because accounting records are based on book value. For example, if you buy a building, it's going to have your building cost on the balance sheet, but that might not reflect what you could actually sell the building for today. So that's a very simplistic way to talk about equity, but in real life, it would be a little more complicated. But basically, first, I want to just show you a balance sheet. We're going to look at this stuff in QuickBooks, even though it's going to be able to be applied to any program that you use for accounting. It's just easier to show this stuff in QuickBooks because QuickBooks is such a common program that people use. So here I am in QuickBooks, and I'm just going to look at the balance sheet real quick. Here are the assets of the business, the liabilities of the business, right here, and then the equity of the business. So in this sample QuickBooks company, you can see that they have what's called opening balance equity. That's just kind of a default setting in QuickBooks. You can change the name of that, or you can put in whatever equity accounts you want, but that's just how it's set up in the sample company. So here's the equity, and then also in the equity section, you'll see there's net income and retained earnings. Net income is simply the profit of the current year, and retained earnings would be profits or loss from prior years. But basically, this entire section right here represents the owner's stake or the owner's investment in the business. If they were to sell the assets, liquidate the assets, pay off the debts, this should reflect what is remaining left over for the owner. And like I said earlier in the video, that's not necessarily exactly how it would work in real life, but the point is, this is basically the owner's stake or investment in the business. Now, if you were to take an accounting class at a college and learn accounting out of more of a textbook format, you would probably see a statement of owner's equity or a statement of shareholders or stockholders' equity, and it's going to teach you that this would be a separate report or a separate statement apart from your profit and loss and balance sheet. So I just wanted to quickly talk about it just because it is an accounting concept that does relate to this video. So basically, in a textbook format, you would learn that you take your beginning equity at the beginning of the period, add any additional owner investments that happen during the period, and owners can invest property, they can invest cash, and things like that. It doesn't necessarily have to only be money. And then you would add any net income, which is just revenues minus expenses. So on that QuickBooks balance sheet, it showed plus net income, and it also showed retained earnings. Both of those reflect income, profits. So same concept here. And then you subtract any money that the owner pulled out of the business, any owner draws. And that leaves you with the ending equity, and that would go on your balance sheet. So if you take an accounting class at a college, you would learn to do the profit and loss, calculate your net income, and then do your balance sheet. When you do your balance sheet, you would put the ending equity. But of course, current accounting programs like QuickBooks and other similar software programs do not show it like this. They show it in a different way. So I think it helps to kind of see both sides of it. And then I also want to point out that if you have a corporation, you would call it shareholder or stockholders equity, and you might have different names of accounts. You would have common stock issued. That means stock was sold, people bought the stock, now they're owners. So the owners invested in the company by buying stock. You would add your net income and subtract dividends that were paid out to the owners. So it's a little bit different, but it's basically the same concept. It's just stated differently, and it's a different company structure. And then I also want to talk about some variations of owner's equity. You may have a sole proprietorship, you may have a partnership, you may have a single member LLC or a partnership LLC. There's a lot of different business formations. So the name you put on your owner's equity accounts may be different depending on what your business structure is. So if you're a sole proprietor, you can keep it simple and call it owner's investment, owner draws, things like that. If you have partners, you're probably going to be more likely to create separate accounts for each partner. So you might have partner A equity, partner B equity, partner C equity, and so on. Now, in a textbook, it's going to teach you to have separate accounts for your owner capital, owner investment versus owner draws. So I didn't add it to the list, but partner capital or owner's capital would also be a good name that I see for owner's equity. Now, my business is a corporation, so I have common stock and shareholders equity, those types of accounts. But I, for many years, had my business set up as a sole proprietorship. So in that time period, I had more of these types of accounts set up. Basically, you just want to have your owner's equity accounts reflect what your business structure looks like. And then I just want to go in more detail about how to distinguish between money you put into the business, money you take out, and any related transactions. So investments or contributions to the business would be money or assets that you invest in your business, and these would be recorded as equity transactions. So if you have a vehicle that you want to contribute to your business, you would put that in the asset account, the vehicle account, and then it would also be reflected in an equity account. And, again, it's going to depend on your structure. If you have a corporation, you're going to be using accounts like common stock, shareholders equity. If you have a sole proprietorship or partnership or LLC or something that is not a corporation, then you're going to have owner's equity, owner's of investment accounts, partner equity accounts. Again, how you state your equity accounts is going to depend on your business type. An exception to this is if you expect to be reimbursed or paid back. For example, if you just go to the store and buy office supplies and use your own card instead of the business debit card, then you might expect to be paid back for that. In that case, you would not treat it as an equity transaction. You would probably just treat it as an expense reimbursement. So you would record your expense and then take it out of the checking account when you transfer it to your own account or write a check or whatever the case may be. If you are loaning the business money and you expect to get paid back, this is not an investment, this is a loan, then you would want to treat that as a liability or debt account of the business. And whether you do a loan or equity transaction is really just going to depend on your specific situation. I would recommend speaking with whoever helps you with your taxes and see if they can help you figure out what's best for your situation. But if you want to loan the business money and have the business pay you back plus interest, then I would see doing it as a liability would be better. Whereas if you're just putting money in, you don't expect to be paid back, other than, your normal profits of the business, your normal paychecks, whatever the case may be, then you would probably treat it more like an equity transaction. And then when you take distributions from the business, again, this is going to vary based on your business structure. If you have a corporation, you're probably going to pay yourself as a W-2 employee. So it would be salary expense, and you would probably use some payroll processing service so that they can help you with your withholding taxes and things like that. You can do it by hand, but the point is, for the purposes of this video, you would be paid more like a W-2 employee. Now, there are situations where you have an S corporation. You might pay yourself as a W-2 employee and take distributions. That's going to be a little bit different, a little more complicated, but the parts that you pay yourself as salary would probably be the W-2 situation. And then if you're a sole proprietorship, partnership, or LLC, then money paid to owners would be recorded as owner's draw, partner draw. And then of course, again, there are exceptions. If you're reimbursing yourself for an expense that you paid with personal funds, then that would be treated more like an expense reimbursement. Or if you're repaying a loan, that's going to be treated as a loan payment. You really want to think about this and make sure you're recording things in the right place. So I'm basically going to walk through some examples in QuickBooks to help you see some of the different situations that may come up. The first example I'm going to demonstrate is the owner investing money into the business to get it started. So let's say they go to the bank, they open up this checking account, and they deposit $1,000 of their own money to get it started. So I would just deposit $1,000 into that checking account, and I would put it as the owner investment. I could have done that with a journal entry instead, and that would have simply been a debit to the checking account for $1,000 and a credit to owner investment. I'm not going to save this though, since I already entered the deposit. Okay, so that would be money the owner invests. So that's going to show up in the checking account. And if I go to the owner investment account, it is going to show up there, and it of course would show up on the balance sheet. I just added $1,000 to the assets, which is the checking account, and $1,000 to the equity section as the owner's investment. Okay, let's also do an example of the owner contributing a $5,000 piece of equipment to the business. So first we'll do an example of the owner contributing that equipment without expecting to get paid back. So I'm going to show you the journal entry for that. So first you would want to show this in an equipment fixed asset account. And then you would also credit owner investment for $5,000. So this is not going to show, it doesn't affect the checking account. Now the business shows $5,000 in equipment and $6,000 in owner investment. Now, if the owner had expected the business to pay them back the $5,000 as a loan, let's say it was a loan to the business, instead of crediting owner investment, you would not want it to affect the investment account. You would probably mark it as note payable, because to the business, it is a loan, a liability. So that's how that scenario would look. Now I'm going to do an example of the owner withdrawing money from the business. So you could show that as an expense, a check. I'm going to go ahead and enter it as an expense. So the payee would be the owner, the payment account would be whatever account it was coming from, and then the category would be the draw account. And let's just say it's $200. And then I would just save and close. So that would show up as negative equity because the owner is the opposite of putting money in. Putting money in is a positive equity transaction, taking money back out would be offsetting that or the opposite. So you can see that negative 200 here under draws. Now you can put your draws and investments in one equity account. It's just more formal accounting to have separate accounts. And then let's look at the checking account, and you can see the deposit minus the payment of $200 back to the owner leaves a balance of $800. Let's go ahead and look at the balance sheet after those transactions. So here's the checking account. Right now it's at $800. Here's the equipment for $5,000. The owner investment of $6,000, and the owner draws, which would be a negative $200 in the equity section. So those were some very simple examples, but I just wanted to give you an idea of what it might look like in your business. And let's just do one more example. For example purposes, let's say the owner went to the store, bought some office supplies for $25, and they want to get reimbursed for this purchase. So in this case, you would treat it like an expense of the business, with the payee being the owner. So the owner would probably write a check to themselves, or they would transfer money, whatever the case may be. I'm just going to assume it was a bank transfer, so I'm going to use an expense. So the payee would be the owner, the payment account would be the checking account, and then the category would not be owner draws this time because the owner's not taking money out for themselves. They are paying themselves back for an expense of supplies. And for these types of situations, I would recommend having receipts and maybe a note . Something like that, just for clarification. If you were later audited, it helps to have notes. Okay, so that was saved, and now the checking account is down to $775, and that would be an expense on the profit and loss. And we could look at the profit and loss, and there's the $25 expense. I didn't want to go too in depth with a lot of examples. I do have a couple of other videos with examples. If you have any questions, please comment below. Please like the video if it was helpful. Please subscribe if you want to watch more accounting videos. And otherwise, thank you for watching.